So let's talk the good, the bad, and the ugly on temporary. Once rates started to go back up, we saw a lot of reintroductions of temporary interest rate buydowns. That doesn't mean every lender offers them, but many do at this point. And the way that works is a seller credit is provided. Technically, there are buyer paid temporary interest rate buydowns. Most buyers would rather just permanently buy down their rate. So typically it comes from the seller. It is a specific seller credit that is needed. It's based on the loan amount and the interest rate we at least predict the buyer will lock in at. That becomes the tough part, is it is based on the specific interest rate that their long-term rate's going to be. So we have to estimate as close as we can, but it is a specific seller credit that is needed. So I do have some agents who are like, oh, hey, I want to negotiate a temporary interest rate buy down for my buyers. What amount would I need? And they don't even have a property yet. So I do tell them like, hey, it's going to be property specific, loan specific. So we have to wait until we're a little bit closer, and then we can give you the exact amount, or at least minimum amount that you need. So for example, let's say you get a $10,000 seller credit, $5,000 of it would be needed to go towards the temporary interest rate buy down the client wants. They now only have $5,000 left to go towards their closing. What happens with the piece that's going towards the temporary interest rate buy down of that seller credit is it's technically being held in an escrow account by their new servicer. So then when the buyer's making their payment, they're making their lower payment that they're temporarily paying. The servicer is taking the difference and they're applying it to it. So the regular payment is still actually being made. And that difference for each month, for however long that temporary buy down is going to be, is what that credit is. So that's why I say depends on the loan amount, the interest rate, etc. Now, each lender will offer different versions of a temporary interest rate buy down. Some may offer what they call a 1.0 buy down, which means they're getting a 1% lower interest rate for just the first year, and then it goes back. Some may offer a 2.1 buy down, meaning they're getting 2% lower on the first year, 1% lower on the second year, back to regular rate on the third. Some will offer 3.2.1. 3% less on the first year, 2% less on the second year, 1% less on the third year, back to the regular. Especially for new construction companies, when they are doing their temporary rate buy downs, that tends to be the one we've seen this year is the 3.2.1. So it's only for a couple of years. Each lender may have different versions. Some may only offer a 1.0, some may offer a 1.1, where it's 1% lower for the first year, 1% lower for the second year, back to the regular rate. And again, that regular rate is the rate that the client decides to lock in at. So that's still their permanent rate going forward, just like they would lock in at a permanent rate on any other loan. And then these temporary buy downs are not offered typically on every loan type. That can also be lender specific. It's typically for your conventional loans. Not a lot of lenders are doing it for FHA loans. FHA investors, not big fans of it. Very few are doing it for VA loans. Again, VA investors, not big fans of it. Never seen it on USDA loan. And any of your down payment assistance programs like SC Housing, for example, they do not allow it. So it is 9 times out of 10, you're going to be using it for your conventional buyers. So the positive is obviously a temporary interest rate that's lower. So again, they've locked in at a 6.5, for example. They're doing a 2.1 buy down. They are making a payment for their first year as if they had a 4.5% interest rate, for their second year as if they had a 5.5, and then back to their 6.5 rate going forward. So it is saving the client hundreds of dollars every month, which is a positive for them. So it allows them to have a little bit of a break in that payment for the first couple of years, and then they'll go back to their regular rate. The hope is during that point, before that temporary interest rate buy down ends, that interest rates will come down and that they can refi. So we have seen some lenders that will talk to clients about locking in at the higher rates that don't cost anything, like par rates in the 7s, and then refinancing by the time the temporary interest rate buy down ends. That is under the assumption, though, that rates will come down to make it worth it. For example, most of my clients who we've done temporary interest rate buy downs, they're still locking in their permanent rate at right around where normal rates are. That's, let's just say again, the 6.5 to 6.7 range. Rates, unfortunately, as we've seen, have not come down substantially over the last couple of years. So a lot of the temporary interest rate buy down individuals, when they're coming out of that buy down here in the next year or so, they may not be at a point where refinancing makes sense. So I do tell all of mine, for that permanent rate, please make sure we're discussing and you're comfortable with what rate you want to lock in at for your permanent time frame. Because if you don't get a chance to refinance, like for example, let's say they decide to lock in at a 7, because there's no cost to that 7 interest rate for them. And then at the end of their temporary interest rate buy down, rates are at 6.8, which they have been this year. That would not be an individual that would refinance and pay closing costs all over again to save like $65 a month. That would not make it worth it. But they also really would probably be unhappy with a 7% interest rate. So I personally have the conversations of, okay, after this temporary rate buy down, if rates don't get any better, what are you actually comfortable with for your rate and what you're going to pay? So the good, lower payment for a year or more. The bad, they may not be able to refinance when it ends. So they need to be careful about what their permanent rate is. The ugly is not necessarily the ugly you may be thinking, but the ugly is mentally paying a lower payment for a year to 2 to 3 years. And then that temporary interest rate ending. As much as we would love to think individuals who are paying a lower mortgage for a small amount of time would utilize that financial opportunity and save that money or make extra principal payments towards it to drive down the interest that they're going to be paying or pay off credit card debt, that's just not, unfortunately, what typically happens. Many buyers who are in this temporary interest rate buy down period now have more money than they thought they would and still end up spending it on non-essentials, I guess we could say. And then they'll call me when it's ending and they're freaking out because now they don't like the payment that they're going to have to make. So it can be mentally not great when those temporary interest rate buy down times are ending. I mean, imagine if your rent or your mortgage, you got to pay $300 less for a year and then $150 less for another year. And then now I tell you, yeah, I'm going to need $300 more. You'd be like, is that what it was? Is that how it worked? And yeah, that's how it works. So I go over it and I go over it and I go over it and I go over it nauseum of, hey, this is not permanent. This is temporary. You need to make good financial decisions and utilize this time to, again, either make principal payments, pay off something, or I tell people still go ahead and mentally pull that money out of your bank account and make your regular payment and then take the difference and put it into a high yield savings account, something. But mentally pretend you are making your payment because you will. A year flies by really quickly. So they can be a great piece to negotiate for your client. It can definitely be meaningful for your client. I do recommend when we're negotiating temporary interest rate buy downs, we are letting the seller's agent know this is what the credit is for, so they don't assume your client has to have this credit because they don't have enough money to qualify. That can be helpful to let the seller's agent know why you're asking for it. They do sign an addendum as well once they've given that credit to show that they understand that's where the credit is going. But it can help with negotiation, letting them know specifically like, hey, our buyer has closing costs. This is something they want to use. If you have any questions or for your clients, how to negotiate it, how to talk about it, let me know.